Building your business was hard, and you only sell it once. With a focus on marketing, communications, digital, and service businesses, the TobinLeff M&A advisory team is dedicated to helping owners maximize and monetize their life's work. Welcome to the TobinLeff M&A podcast.
Hi, I'm David Tobin from TobinLeff M&A advisory firm. I am pleased to be here with my partner, Chuck Gottschalk. Chuck at TobinLeff is what we refer to as the heavy, a transactional partner. At TobinLeff, we've found that it serves our clients well to have relationship partners that are working with clients on vision, values, cultivating buyers, supported by somebody with deep expertise in M&A work. You're going to hear about Chuck's background in a moment. The topic that Chuck and I want to talk about, it's one that is fiercely discussed, negotiated. We're calling this topic, the title, Working Capital, a Battleground in the M&A deals. Chuck, before we go to why it's a battleground, working capital, your background.
Yeah, Chuck Gottschalk from Pittsburgh. I come from a family of accountants. I'm a CPA by training. I was a senior manager with Ernst & Young. I spent 18 years as the CFO, COO of a couple operating companies for a family office. Internally, you think of me as heavy. They also refer to me as the numbers guy. And it's because of my background with numbers and data mining all the way back in the 90s when people weren't even doing data mining yet. So I understand numbers.
And you've been working with M&A transactions almost 25 years.
I've been working with them on and off for 25 years. I was in operating companies. We would buy and sell along the way. That was just sort of a tangential responsibility. The last 7 years working with you, David, it's pretty much still been focused on M&A.
Working capital. Owners, sellers who are thinking about going through the process, they hear about it. What is working capital?
I like to refer to sometimes working capital as the gas in the tank. When you're selling a business, you're selling a stream of future earnings, and I call that the vehicle. And the working capital is the gas that makes that vehicle run. And when you sell a business, it's a going concern. And that means that the buyer wants to step into your shoes and be able to operate the business as you had. And that means that on day one, they want to have working capital or gas in the tank to make the business go. They don't want to have to buy the business and then load up on working capital as well.
You refer to it as what it does, but the technical is working capital is what, current?
I like to keep it really simple and say it's for purposes of M&A, at a high level, you could think of working capital as accounts receivable minus accounts payable. It gets more complicated than that, which is why it's a battleground. But at the highest level, if you just think about it as accounts receivable minus accounts payable, and if you had a perfect business that was consistent and you had $1 million of AR for 12 straight months and you had $250,000 of AP for 12 straight months, your working capital would be $750,000.
The difference between the two.
The two, that's right. It's a net. It's an asset minus a liability.
And it sounds so simple.
Yeah, but it's not.
It's not. Case in point, why is it complex? Why are these negotiations and discussions?
So as a CPA, we have these strict rules that's called GAAP accounting, generally accepted accounting principles. It's an objective set of rules. And you can get most accountants in a room together and they will agree on most numbers. Working capital isn't a defined term under generally accepted accounting principles, especially when you get to an M&A transaction. That makes it part art, part science. At the end of the day, sellers want to have the lowest working capital target possible. Buyers want to have the highest working capital target possible. If a seller has to deliver more working capital, it literally means less cash at closing. It's a very simple mathematical equation. And the buyer recognizes that if they get more working capital, in a sense, they're getting a reduction in purchase price.
So you and I have witnessed the complexities. I'm thinking back to talk about that one transaction where two Q of E providers spent almost 6 weeks just negotiating and focused on work. Why?
Yeah, because again, it's part art, part science. And then the other thing that we see so often which I find incredible, and we get called into transactions just to work on this aspect, is that people just don't do their homework. They just don't understand what is actually on the balance sheet. They look at this account and we see it's called deferred revenue. It's often a big battleground in the working capital area. And they don't even understand what's in deferred revenue. Deferred revenue, the accounting concept is that you've billed for something that you haven't done the work yet. Now, if it's in accounts receivable, it's a very different answer than if you've collected it. Because we talk about M&A transactions in the working capital world being cash-free, debt-free, but that's just theoretical. It's not really how the deals work. That's a classroom example. That's the textbook example that I gave earlier where I said $1 million of AR and $250 of AP, it's $750. It never works that way. These things bounce up and down, and you have to work through that.
What are some common mistakes business owners make related to working capital?
So I think the most common mistake that I see that business owners make in working capital is that they don't treat the business like they did when they started the business. And what I mean by that is when people start businesses, cash is tight, and they manage cash aggressively. And what they want to do is they want to go out there and they want to collect the AR, and they want to pay the payables on time when they're due. So if somebody says, this is due in 60 days, they pay it in 60 days. As companies become more profitable, they kind of become fat in a way. And all of a sudden, if somebody doesn't pay them on time, they don't get too excited. And they'll say, well, the invoice came in, just pay it when it came in. And that's actually a horrible policy, because if you look at that mathematical equation about what you have to deliver, AR minus AP.
On average, over some period of time.
On average. If all of a sudden you start letting your customers pay you 30 days later, your AR goes up. You have to deliver more working capital. If all of a sudden you start paying your vendors early, your AP goes down. And all of a sudden that working capital, which was in my simple example, the $1 million minus the $250 or $750, it can grow to $1.5 million on the AR side and $125 on the AP. And all of a sudden now you're leaving $400,000 or $500,000 on the table. And those might seem like big numbers, but I've seen millions of dollars being left on the table. And we fight for that. And sometimes, we'll give this example, David, you remember this client came to us. They were so loose in the terms of their collection, we told them they had to wait a year to sell. Otherwise, it was about a $5 million adjustment.
Because most buyers will look back on average 12 months.
That's correct.
So if somebody's thinking about selling their company in a year or two, now's the time to become educated on working capital.
Yeah. And
take steps on what they can do. It is more complex than just receivables and payables.
Yeah, but it's no more complex than running it like they used to run it when they started. If they go back to that basic of I need to collect my AR on time, maybe even a little bit early, and I'm going to pay my bills when they're due. If they focus on that basic concept, they'll get a great working capital answer.
Chuck, I've heard you say you like to be the equalizer in the room, and I've witnessed it, and many of our other partners have. That's just touch on that. What typically comes when somebody signs a letter of intent, they're going into due diligence, and what's needed to support them? Yes.
So most often what we see is companies are acquired by larger companies. And those larger companies oftentimes have people such as myself, Big Four experience in the room, doing the analysis, doing the calculations. Most of our clients don't have Big Four accountants representing them. But on this area, when TobinLeff is involved, they do. And that becomes the equalizer because nobody's going to pull the wool over our eyes. I say working capital should be fair to a buyer and seller. I talk a lot about equity in my deals. We can sell your company for what it's worth, not more than what it's worth. And we can allow you to deliver the working capital you should deliver, not a theoretical amount from a textbook.
Great. Related to the topics that Chuck and I just talked on, if any of you have questions about working capital, some of the financial aspects you're thinking about, reach out to Chuck, reach out to me, any of the partners at TobinLeff. We're happy to just have discussions with you. You can find us at TobinLeff.com, see Gottschalk at TobinLeff.com. Thank you for listening. Thank you for viewing.
Thanks for listening to the TobinLeff M&A podcast, produced by Main Impact with music by Holt Vaughn. For additional resources, case studies, or to contact a partner today, visit TobinLeff.com and be sure to subscribe or sign up for our emails to never miss an episode.